It's a key and vital concept to understanding how to look at markets. And that is extreme opinions shared widely constitute the single most reliable indicator of an impending change or direction for a market. All right? I can't stress this point strong enough. People talk about, oh, well, you know, this sector has great earnings and great visibility and you know, the people want to own it, but all of that is a rationalization of an emotional-based decision, okay? The base decision on why people want to buy any market or any stock or any asset is very simple, but very profound. And that is because they think the price is going up. They think they're going to get rich. It's an emotional-based decision. And everything else, you know, the magnanimous personality of the CEO or the great earnings it had or the fact that it's on USA Today's cover, whatever, it's a rationalization of emotional-based decisions. So you've got to focus in on the emotion. And when that emotion gets extreme, and that extreme is shared widely, when a lot of people are thinking the same thing, presumably they've already acted upon their emotions and their beliefs, and it leaves fewer people left behind them to keep the trend going. That's when it's at the risk for reversing. And we can see this clearly in gold. During that entire rally, we had extremes building and building and building. And this chart was shown in the October 2011 issue of the Elliott Wave Theorist. This is Bob Prechter's newsletter. He showed this and the extremes that were occurring as gold was making its last leg up into its rally. We started with 98% bulls in the Daily Sentiment Index, DSI. It's simply a daily poll of traders. Only 2% of traders thought gold was bearish at that point. All right? One Wall Street strategist who's very well known and has been at this money show said, not owning gold is a form of insanity. Like, can you imagine? It's insane not to own gold. Of course, radio ads were coming out forecasting 5,000 gold prices. All right? We had another 98% bull. Venezuela nationalized its gold industry. And all these were extremes. People wanting to own gold so bad that they were going to the extremities. And that, of course, was the end or building to the end of the rally. All right? That chart came out in October 2011, 7 weeks, or I think it was actually 4 weeks after gold registered its all-time high at 1921.50. And it's declined over 30% since then. Right? But probably the greatest extreme that we saw and was a very strong signal that gold was topping, and we were talking about this in our newsletter, and we actually showed this next chart in the Elliott Wave Financial Forecast beginning in June 2011, was that major governments were moving in and out of gold. Now, that was such a great signal for us. For example, gold had been in an over 20-year bear market from 1980. Look what happened in 1999. The Bank of England was so certain that the trend was going to continue lower that they wanted to sell their gold holdings. They saw no reason to continue owning gold because they were so certain that the price is going to be lower in the future. You might as well get money for it and invest in something else. So they, along with 15 European central banks, agreed to sell their gold. That was a signal. That was an extreme. Governments are usually the last to act on a trend. And the reason being is because they act by consensus. So by the time that governments come around to sell their gold, usually you're near the end of the trend. In fact, gold started on that long rally. World central banks sold more than 4,000 tons on the way up. What happened in 2011? Central banks woke up and said, wait a minute, gold's rallying. We don't want to sell it, we want to buy it. All right? That was a signal that we were near the end of the trend. And in fact, that's what happened when we hit that top line in September 2011. So another signal to us of this aftermath of this bear market is that look what happened when the Fed announced its $1 trillion a year debt buying program, which is QE3 or QE4. I get them all mixed up, but that's what was happening. Gold, it was a perfect time to sell gold and silver, and we said so in our newsletters. And in fact, this is one of the charts that Bob published in December of 2012, just as Ben Bernanke was announcing his new program to issue and buy mortgage and treasury bonds. It was right at the end of this rally. We said it's a good time to be selling gold here. And in fact, this is an updated chart. You can see what gold prices have done since then.